Let's dive a little bit deeper into all of the market action right now with all of our reporters standing by. Taylor Riggs, you are up first.
Yes, well, and as you guys talk so much about all of these record highs, I wanted to take a look at where we are in terms of bonds versus stocks. Now, we do know that as stocks have been rallying, so have bonds. That's interesting because the correlation between the two have been slowly declining over time. The correlation now is at the lowest really going back since a year. But interestingly enough, it actually might still be attractive to be buying stocks over bonds. If you come and take a look at a chart here that I'm showing inside my terminal, we're looking at the dividend yield above the 10-year yield. Dividend yield is still offering more returns than the 10-year Treasury yield. So even though bonds are high and stocks are high, it actually still might be making sense to buy those dividends over those Treasury yields. Abigail?
Taylor, let's bring volatility and the VIX into the stock equation, because right here what we're looking at is the Vix curve, because as we have this melt up for the S&P 500, the VIX, or the quote-unquote fear index, at super low levels, below 12, the lowest levels we've seen in about a year. But beneath the surface, we're seeing the curve steepen, in fact, the steepest in 3 years. So basically what this tells us that even though volatility is low right now, the realized, the implied volatility going out further is steeping, again, the most in 3 years, especially toward that March quadruple witching month, Mike, where there's lots of liquidity and volume for big asset managers. It suggests that we have some of those big asset managers either putting on puts for hedges against some kind of volatility, or perhaps they're making an outright short bet. But either way, it appears as some are preparing or looking for some big volatility for stocks, perhaps in 2020, Mike.
Well, thanks, Abigail. Well, here's something we can all be thankful for going into the holiday, and that's the Atlanta Fed's GDP Now estimate of gross domestic product growth in the fourth quarter. Really perked up this week after the durable goods orders data and the trade deficit data. In fact, this model of growth in the fourth quarter was as low as about 0.3% just 2 weeks ago, as you can see in the chart. It's really perked up since then after these latest data points. It's now pointing to growth of about a little less than 1.7% for the fourth quarter. Still not strong, but a lot better than what it was looking a couple weeks ago. And Atlanta Fed saying basically that domestic investment is less of a drag on GDP after this data, and net exports went from being a drag on GDP to a contributor to growth in this quarter based on these latest figures.